My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to make a little money. My job is not just to entertain, but to educate, teach. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Here's what the bulls want to happen in this environment. We want weakness throughout the economy, except when it comes to our companies. We want rate cuts, even if inflation is only somewhat under control. We want our companies to be less cyclical, less beholden to interest rates. We want their demand to be so great that they don't have to worry about the yield on the 2-year, the 5-year, whatever. And I got to tell you something, it's all very confusing. On a roller coaster day where the Dow ultimately lost 115 points, S&P inched up 0.11%, and the Nasdaq gained 0.56%. In other words, you know what we want? We want Dr. Pangloss. All is for the best in the best of all possible worlds. But there's no such thing as Pangloss reality. Even in Candide, he's a joke. You can't have a weaker economy with lots of companies making fortunes. It doesn't happen. Other than utilities and some drug companies, there are very few companies that can make their numbers unless things speed up. We know they need a faster economy because we got a manufacturing ISM report today that was eye-popping. It showed that, and I'm going to quote here, economic activity in the manufacturing sector contracted in May for the second consecutive month, but the 18th time in the last 19 months, end quote. Come on, man. It goes on, quote, the new orders index remains in contraction territory, registering 45.4%, 3.7 percentage points lower than the 49.1% record in April. That was, I think, a little frightening. And it goes on to say, quote, demand remains elusive as companies demonstrate an unwillingness to invest due to current monetary policies and other conditions, end quote. That is pretty disconcerting. Now, I am not so sure that everything's weaker out there. We know that Dell was down a lot last week over concerns that maybe the business world is not strong enough to justify building out all these data centers. And they are Dell's bread and butter. Anything negative for Dell makes us think twice about the AI-fueled data center build-out that's inspired so much stock buying, which until last Thursday, everybody assumed was the biggest demand generator out there. More on that later. For now, you just need to understand how Dell's decline could lead people to a very negative conclusion about one of the fastest-growing parts of the economy, the data center. You know what? I think they are absolutely wrong to reach that conclusion. But what do I matter? We see oil in total collapse, right? Now, again, there are major mitigating factors, including a roadmap for how big producers can eventually bring more oil to market. But just as Dell's weakness could possibly mean weakness in the data center, investors are convinced that the lower oil means pending recession because we're just at the start of summer driving season. They don't think that lower oil could lend to rate cuts themselves. I think that's a big mistake. As for me, like with Dell, I want to buy the oil zone weakness. I don't care about technical breakdown. I think the economy weak enough to crimp demand for gasoline. I like Coterra, which has equal amounts of oil and natural gas. Oil is less cyclical than it used to be, but it's totally hostage to the decision of nation states. And it's only in the 70s because the war premium from Ukraine and the Middle East. Retail's got the same darn feel. The haves like Costco, Walmart, Burlington Stores, TJX are all about saving money for you, the consumer. People see them as exceptions that prove the rule, with the rule being that retail's in slowdown mode. But, man, when you look at, how about the Gap, Best Buy, Dick's Sporting Goods, Williams-Sonoma, Ralph Lauren, these are retailers that are doing fabulously. The action retail's more hit or miss than signaling a recession around the corner. You just have to be a little more discerning. Today, a longtime bear from Citi, who started covering Best Buy on March 8th of 2021 with a sell, actually double upgraded the stock because it might be the biggest beneficiary from all the new AI-powered PCs. As Investing Club members know, I agree. BBY is a terrific name. Or how about the machinery plays? They may be throwing you off the scent, too. We're beginning to see cracks in companies that buy equipment because they don't need it now that there's a lack of new home building. Devastating for the likes of Caterpillar, Vulcan Materials, isn't it? I say it's devastating for their stocks, not their businesses, which are doing just fine and are far bigger than housing. Transportation, okay, what the heck did happen with FedEx? It's getting crushed. Union Pacific, oh my, can you believe that? Old Dominion Freight, J.B. Hunt, all signaling that things are getting very tough out there. But these stocks are highly emotional stocks. entities that respond to a host of different inputs. So do the airlines, which aren't truly getting hit. Only American is weak because they had a strategy that wasn't working. Finally, there is one real black hole out there that is unequivocal, and it's a place we've never had it be a black hole, and it's called enterprise software. We know these stocks are weaker, but as I wrote to members of the Investing Club this weekend, I wish you guys were members, because this one ruined my weekend, but I thought it would be good for you guys. I ruined my weekend with my wife. It's okay. It's good for you. Didn't come out right. It's just good for you. Every business is wondering how many people will have to lay off because of AI. So why on earth would they sign up for cloud software subscriptions for more users? They need to figure out what their workforce will look like before they make these kinds of decisions. So I actually think that there's a recession developing in enterprise software. That is happening. But so far, it hasn't spread to enough companies to truly impact the tape. That's the only area I know that is in real trouble. Against all this, you might have watched the keynote of NVIDIA's Jensen Huang at the Computex conference in Taiwan this week. You got to watch. It's really great. Jensen believes that if you buy one of his Blackwell chips, it will make you more money than it costs. As he put it this weekend, the more you buy, the more you save. He goes on to emphasize that NVIDIA is so far ahead that I actually started thinking, geez, maybe they're the only real winner in generative AI. There are so many partners who regard themselves as winners because they're in the same room as Jensen that it seemed like a real comeuppance. Again, I think that's a mistake, though. There's a great secular case to be made for accelerated computing and generative AI. The idea that there can only be one winner, NVIDIA and NVIDIA alone, is just inconceivable to me. The whole point of NVIDIA is that it's enabling winners everywhere. But Wall Street's too hung up on Dell's meltdown to believe it. That's wrong. NVIDIA raises everybody's game. And, of course, there are the tremendous drug stocks. AstraZeneca and Johnson & Johnson announced some breakthroughs in fights against cancer this weekend, specifically for heretofore intractable situations. AstraZeneca seems like a steal to me. J&J, beset with litigation risk, I don't care for it. Oh, and don't forget Eli Lilly, which is so much going forward that it can transcend the rest of the economy, even more than your typical drug stock. But let me give you my brief. When you read the statement from the manufacturing PMI, it is weak, weaker than feared. That will cause inflation to cool. Fewer price increases, more price cuts. Housing goes down in price as young people move back with their parents. The old car will do just fine. You'll change your auto insurance to where your collision doesn't kick in when you have a small accident. And that's ultimately what could sway the Fed, particularly if we get any sort of job weakness on Friday's numbers. So the bottom line, you may think that these negatives are happening right now. Many of them happened already, though, and they've been baked into the relevant stocks for months. Your best bet is to accept the degradation and just wait. There are now brown shoots everywhere. And frankly, I think it's exactly what the bulls needed. As long as J-Powell sees the weakness and knows that it can still be corrected. Bob in Illinois. Bob.
Hey, Jim, how are you doing?
I am doing well, Bob. How about you?
Well, I'll tell you in a minute. I've enjoyed a nice run on Kava.
Oh,
and,
yeah.
The last couple of days, it's declined, particularly today. And I got stopped out about 93, and it's off about 5 points today. I'm wondering if a good point to get back in, which I plan on doing, or shall I wait it out, or is that a good place to get in, or what's a good entry point?
Okay, well, let me tell you, I have some rules in these that might help us. For Kava, okay, the stock's high was 96. It's down to 88. I would think on a red-hot stock like this, as we saw with ARM, you've got to wait until you get maybe a 15 to 20% decline. We're not there yet. But when we get that, I would indeed pull the trigger. Zach in Pennsylvania. Zach.
Hey, Jim, big booyah from Eagles Nation. How are you?
Man, Eagles Nation. Saquon, I think Saquon's playing. He's still playing for the Giants. He's like the best running back in the league. If we could get him, everything could change. How can I help?
I hope to see you in an Eagles game this year.
Oh, yeah.
So I am in my mid-30s. I'm looking to start moving some things. I want to sell half this position, and I want to move it to possibly the S&P, but my stock is Carrier Global.
Oh, man, don't sell Carrier. Jeez, David Gitlin is doing such a great job. I think you leave before he's got work to do. He wants to get that stock much higher, and he will succeed. Do not sell Carrier. Go Birds. All right, there are now brown shoots everywhere, and I think it's exactly what the bulls need. As long as J-Powell sees the weakness that we do and knows it can still be corrected. Mad Money tonight, I'm going to be reading the S&P 500 names that came out on the top and bottom of the pack this May. Then what's behind Dell's 20+% decline since last Thursday's report? I'm breaking down the quarter to see if investors are getting a buying opportunity. And during this turbulent time for the restaurant industry, I'm sitting down with former Yum Brands CEO David Novak on the eve of his leadership book release to get his take on a host of market-moving news. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
In retrospect, May was a pretty crazy month. While the averages still finished the month up nicely, Dow gaining 2.3%, S&P climbing 4.8%, NASDAQ jumping nearly 6.9%.
House of pleasure.
When you dig deeper, there were lots of big winners coupled with big losers, thanks to dramatic earnings season. So before we get too far into June, I wanted to go over the biggest winners and losers in the S&P 500 last month, because they can tell us a lot about it's really about what this market is saying to us. So let's start with the top 5. The best performing members of the S&P 500 in May. It was First Solar, yes, the Cramer fave, mostly domestic manufacturer of industrial grade, that means not rooftop, your own personal rooftop, industrial grade solar modules. First Solar shot up 54% last month. Now, I've long recommended this one as my favorite solar play because the company's actually profitable with the largest domestic manufacturing presence in the industry and lots of exposure to industrial scale projects, which is where the real money is. Sure enough, on May 1st, First Solar reported a monster 20-cent earnings beat off a $2 basis, but the real driver of the rally came down to some regulatory developments. The Biden administration introduced a new round of tariffs on Chinese goods, including solar cells, where they raised the tariff from 25% to 50%. Woo! And you know what? The tariff worked. The very next week, the Chinese government told their solar companies, end the price war that's been crushing the entire industry. That sent First Solar up 18% in a single day. It has been running ever since. Now, I wouldn't be surprised if it's got more room to run. That tariff hike hasn't even really got into effect yet. Second best performer in the S&P 500 last month, Deckers Outdoor, the parent company of some iconic footwear brands like UGG, Teva, and mostly importantly, Hoka running shoes. Now, you may have just been able to look at this and find this name, because if I don't know about you, but everybody's wearing Hoka when it comes to my crowd. I just highlighted this company as one of the few sources of growth in the footwear and apparel space. Just a couple of weeks ago, I really stuck my neck out, but because I was a week before Deckers reported. Fortunately, they delivered a fantastic quarter. $4.95. Street was looking for merely $2.97, thanks in large part to the strength of, yes, indeed, Hoka sneakers. No wonder the stock was up nearly 34% last month. Third best, Vistra, up more than 30% in May, and this is another company that's on our radar. I talked about it as a homework name a week ago. Vistra is one of the few unregulated independent power producers in a world where our country's desperate for electricity, thanks to all the data centers we've been building to support artificial intelligence. This company seemed enticing because it's got nuclear exposure, and I gave you my blessing to buy it on weakness, along with Constellation Cramer fave Constellation Energy. I have these in my mind because these are the weakness that I've been waiting for. That means you have to do some buying. In the last 2 trading days, Vistra's pulled back from 105 to 93 as part of a broader decline in anything related to AI infrastructure that's not in NVIDIA. I think people are overreacting to Dell's seemingly lackluster quarter last Thursday. That did get to people. I'm going to give you more on that later. For now, just know that I think you're getting a buying opportunity in Vistra, buy, and its nuclear fellow traveler Constellation. The fourth best performer in the S&P 500, HP Inc., with a gain of nearly 30% for 2 reasons. First, on May 20th, HP unveiled a new class of next-generation AI PCs at a Microsoft AI event. People laughed, they yawned. They shouldn't have. Like I've told you before, there's a PC refresh cycle coming, fueled by new AI functionality. And HP's looking like it might be first to market with one of these computers. Theirs debuts next month. That's why we've been recommending Best Buy so hard for the club. Then HP followed that up with a good old-fashioned earnings beat last Wednesday night. Unlike Dell, where the expectations got way too high for the quarter, HP Inc. was up less than 5% over the previous year going into earnings. So when the company turned in modestly better than expected results, with positive commentary about the upcoming PC upgrade cycle, its stock soared almost 17% in a single day. Frankly, I still like Dell a bit more than HP, but HP deserved every penny of its May gains. Rounding out the top 5 performers is a stock that we haven't thought of as a winner in years, Moderna. The high-tech vaccine maker saw its stock rally more than 29% last month, even after pulling back from 166 to 142 last week. Moderna started running what's reported a better-than-feared quarter on May 2nd, then got another boost when we learned that they were in talks with the U.S. government to develop a bird flu vaccine. Remember, we've got a horrific bird flu epidemic that's already jumped to other animals. For most of the month, Moderna also got a boost as people expected the FDA to approve the company's RSV vaccine. Last Friday, that's exactly what happened, but the stock tumbled 6% on the news, investors locking in profit. Honestly, I'm not sure what to do with Moderna here. I'm happy to see the company do terrifically, finally, post the COVID era. But Moderna is expected to lose money for the foreseeable future, and I think there are better opportunities in the biopharma space that are not losing as much money. How about that? Now, let's talk about the 5 worst performers of the S&P 500 for the month of May, and there's a lot of similarities here, even though it looked like things were glaring. The biggest loser in the S&P 500 is a name you may never heard of. It's called EPAM Systems, EPAM. And that was down more than 24%. This is a hybrid tech consulting and outsourced software engineering company. Oh, man. Unfortunately, that's about the worst business to be in now that companies are trying to figure out how to spend less on enterprise software. Early last month, EPAM reported an okay quarter with dismal guidance, got stock killed. Right behind EPAM are 2 human capital management software plays. Stop me before I hurt you. Another area of enterprise software that is in bear market mode. Paycom software down almost 23%. Dayforce, formerly known as Ceridian, which was formerly known as Control Data, down more than 19%. Same story. We have too many enterprise software companies that do the same thing. Even Workday, the best player in the space, is struggling to these lesser competitors aren't even worth thinking about. Next worst performer, Global Payments, down 17%. This is a financial technology play that's part payments company and part, yes, enterprise software. They help companies process payments and automate their accounts payable and accounts receivable options. And they also do payroll software. Again, enterprise software is a bad place to be. I got a half dozen companies that do the same thing. Global Payments reported on an okay quarter on May 1st, but it left its full-year forecast unchanged, and that sent the stock down 11% in response, and it keeps falling as it realized, well, the whole cohort's in trouble. Finally, rounding out the worst performers in the S&P 500, there's Expedia Group, which fell 16% in May after a company reported a bad quarter early on, and the stock never recovered. Expedia was hurt by a slowdown in consumer travel demand here in the U.S. and some company-specific issues like a disastrous tech migration project that caused a multi-day outage in their home rental platform, VRBO. And that's why I prefer Booking Holdings, because it has much more exposure to the rest of the world. As for Expedia, putting that one right in the penalty box, at least for a bit. Bottom line, when you look at last month's biggest winners, they come from a wide variety of sectors. But when you look at the losers, it's enterprise software all the way down, with the sole exception of Expedia, with its exposure to the wrong parts of the travel industry. Like I said at the top of the show, the companies doing poorly are visible but deceptively powerful. They don't deserve to take the whole market down. But some of them truly worry those who don't understand how corporate-specific these stories really can be. Mad Money is back after the break.
Coming up, tech was a wreck last week, but one venerable name took the hardest hit. Cramer finds out why Dell fell and what you can do about it. Next.
Remember, dude, you're getting a Dell? Now all I think is, dude, what the heck happened to the stock of Dell? Last Friday, the iconic PC maker with a huge enterprise business saw its stock lose nearly 18% of its value before sinking another 5% today, all because Dell reported a widely panned quarter on Thursday night. Whoa, was it ever? Keep in mind, going into earnings, this was one of the hottest stocks on the planet. From the end of 2022 through Thursday's close, this thing had given you a phenomenal 323% gain. The previous 2 quarters caused the stock to instantly roar higher. In short, it came in as hot as you could possibly have, and it was pretty much priced for perfection. Worse, the devastation in Dell doesn't really jive with everything else we've seen in tech. We know that enterprise software has become a no-man's land. We've established that, right? Because customers still need to figure out how much to spend on this stuff now that AI is changing the world. But that's also been a major opportunity for the hardware side, the Dell side. As businesses spend fortunes to build out their AI capabilities, Dell is a key NVIDIA partner, for heaven's sake. HP Inc. reported a great quarter that sent its stock into the stratosphere. So we need to figure out what went wrong with Dell, because the stock's post-earnings meltdown really does call a lot of things into question. It shattered a lot of people. Before we start jumping at the shadows, you need to understand that Dell's actual results, they were fine. The company delivered a clean revenue beat with better-than-expected sales for both infrastructure solutions, their servers and storage business, as well as their client solutions group, which is all about personal computers and peripherals. The real strength here is in the infrastructure solutions division. It was up 22% year over year, including servers and networking up 42%. Now, the earnings lines weren't as clean as the revenue lines. Dell only posted a 2-cent earnings beat off a $1.25 per share basis, and both their operating income and net income came in a bit light, while their free cash flow was down 9% year over year. That was a little unfathomable. Management's guide, let's call it mixed. For the current quarter, Dell's revenue outlook was higher than expected, but its earnings outlook was a dud. For the full year, management raised their sales and earnings forecast, but warned of larger gross margin declines than previously expected, thanks to inflationary input costs and a higher mix of AI-optimized servers. Problem is, they didn't raise the earnings forecast enough. It really caught up to what Wall Street was already looking for. Ooh, boy, that's bad. So what went wrong here? The first issue is simple. The expectations just got too high. Just in 2024, this stock had already more than doubled, up to 122% for the year as of the close last Thursday night. And much of those gains came in the weeks leading up to earnings. Dell was just under 125 at the end of April, and it roared to 170 right before the quarter. It did look unsustainable. Meanwhile, as the stock rallied and rallied, the analysts raised their price targets to stay in the same ballpark as the stock itself. And then were basically forced to raise their estimates to justify themselves. When Dell raised their full-year forecast to a midpoint of 765 last Thursday, Wall Street considered that a merely in-line figure. But at the end of February, those same analysts only expected them to earn $7.16 for the full year. It's just that they spent the next few months aggressively bumping their numbers. By the way, Dell's still stuck on this great expectations treadmill. Over the last few days, the full-year earnings consensus has crept up to $7.74. And I'm just talking about the official sell-side analyst numbers. Dell also has to contend with what's known as the whisper number, the numbers that its bullish shareholders are really expecting. These aren't tracked anywhere, so there's no such thing as an official whisper number. But bullish hedge funds were looking for something a lot higher than even the analysts projected. To them, the full-year forecast was a flat-out disappointment. They were big sellers. So the main problem is that Dell failed to live up to irrationally high expectations. The expectations that fueled the stock's stunning rally this year. That's the main reason the stock got clubbed on Friday. But there's something else that went wrong, too, and this problem is more meaningful. Basically, with this quarter, investors came to realize that maybe Dell's AI business, the big growth opportunity here, might not be as profitable as we thought, at least not initially. Of course, the AI numbers that Dell reported were pretty strong. In fact, the sales momentum is incredible here. Management says that shipments of specialized AI servers more than doubled versus the previous quarter, and their AI server backlog increased by more than 30%, again, just versus the previous 3 months. Those numbers are insane. But it's not doing much to drive higher earnings, at least this moment. During the Q&A session, in a momentous time on that conference call, the very tough, very smart Tony Sacconaghi from Bernstein put it bluntly, and I'm going to quote this because it was so tough. You added $1.7 billion in AI servers and operating profit was flat. So does that suggest that operating margins for AI servers were effectively zero? And if that's the case, how do you square that circle, end quote? Oh, man. CFO Yvonne McGill explained that they are expect operating income on the enterprise side to improve over the course of the year. But for the moment, she indicated that the AI business is not as profitable as Dell expects it'll be in the future, ideally the not too distant future. Right now, the problem is that large enterprise customers are driving the orders, and they tend to get better deals than smaller, medium-sized customers, so it leaves less for Dell. Later in the call, management went on to say that there are other higher margin parts of the AI business, specifically networking and storage equipment, and especially services like fully managed solutions, where Dell will basically build your entire NVIDIA-based AI hardware stack for a fee. But those businesses will scale later on. For now, much of the AI business consists of selling AI-optimized servers to large customers that negotiate good deals for themselves. So it's not as profitable as Wall Street seems to have wanted. So that's what happened. Expectations got out of whack, and the market suddenly started applying a higher level of scrutiny to the profitability of Dell's AI business, not just the growth. Now that you know that, let me ask you, do you really think that Dell stock deserved to be down 22% over the past 2 days? I certainly don't. For some perspective, with this pullback, the stock's back to its lowest level since May 13th. It didn't even roll back 3 entire weeks of gains. Dell's still up 73% for the year. I think it was a healthy pullback for a stock that had gotten overheated. Let me put it another way. Before the quarter, Dell was selling for almost 23 times this year's earnings forecast. Now the forecast is higher, and the stock's a lot lower. So it's trading at roughly 17 times this year's numbers. I want that stock. I want it for the portfolio. Bottom line, Dell just got substantially cheaper while the expectations are more in tune with reality. Meanwhile, I think the fundamental AI story is very much on track. It just might take a little longer to play out. So I'd be a buyer. Let's go to John in New York. John.
Hey, Jim, how are you? Thank you for taking my call.
Of course, John. What's up?
Tesla.
What's
regarding
up?
Tesla,
Yeah.
I know that there's a lot of volatility in the company, but also I'm concerned about the unpredictable behavior of Elon.
Right.
So, and again, I'm investing for the long term. What's drop it, buy more?
No. Look, I think that. Look, I'm not saying that at $562 billion, the thing's done. I think if Elon gets the contract that he deserves, by the way, because it's really etched in stone that he was supposed to get what he got. And if they can make the cars into more autonomous machines that go do things for you, like you say, hey, listen, go pick me up a pizza at the Pizza Vita, and it goes to Pizza Vita, and then the guy gets, and then the guy brings it into the car, and then it comes back to you. That is what I call autonomous driving. When that happens, well, maybe it's just worth holding Tesla at these prices for when it does. Let's go to Nick in Florida. Nick.
Booyah, Jimmy Chill. I want to first thank you. I want to thank you for your keen insights every day and for your thought-provoking angles that you create with your interviews.
Well, thank you, man. That's awful nice.
Yeah, I know you have to keep it fresh, and you have no problem. Every day is so interesting.
Well, you know, if you talked to my wife, she would say, like, "What are you reading? What are you reading?" And I'm always like, "Well, I'm reading about." I don't know, Dell. And she's just like, why don't you just put it down? And the answer is you. It's because of you. I can't put it down because then when you call me about a stock, I won't know it. So let's go to work.
Well, two things have changed a lot since I've been watching this show. One is more transparency with the CEO selling, insider selling. And the market speed has changed. Sometimes with bad news, it's face-ripping market speed. And my question tonight is regarding the company Samsara, IoT. It has AI capabilities, a promising future. But how much is the stock affected with its recent insider selling by their CEO? Is it a buy, a sell, or is it a pause and buy?
You know, I do think that the selling was large for the CEO relative to the small size of the company. But that said, what really bothers me is that I am not an enterprise software guy right now. I don't like these stocks. They're too expensive. And my take is that Samsara is not a stock that you want to own. Period. End of story. All right. Now, Dell just got substantially cheaper while the expectations are more in tune with reality. So I say, dude, get yourself some Dell. They have much more money, including my exclusive off the tape with David Novak, a leader among people. Don't miss my chat on leadership and more with the man behind so many of our favorite foods, including Cool Ranch Doritos. Yes. And then what should you make of the market's meme stock action? I'm going to give you my take on Roaring Kitty as he continues to make the headlines. And of course, which, by the way, is like, hey, and it's like a Cole Porter. We have a Cole Porter market with the SEC. Anything goes. And all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. When we talk about what makes a company great, most people don't give enough credit to leadership, which, by the way, is a good way to pick stocks. The difference between top-notch leadership and mediocre leadership is like night and day. So what makes for successful leadership? To answer that question, well, we're going to a successful leader. We're consulting with David Novak. He's the co-founder and former chairman and CEO of Yum Brands. Been on the show a lot of times. Parent company Taco Bell, KFC, Pizza Hut. He was running things back when Yum was in the glory days, but I've got to tell you, they're still doing pretty darn well. David's new book, How Leaders Learn, comes out tomorrow. And it's all about the essential habits and strategies of the world's most effective leaders. Tonight, we're lucky enough to have David Novak on set set with us so we can learn more. Mr. Novak, welcome back to Mad Money.
Jim, it's always a pleasure being with you.
Well, David,
good to see you.
I listen to your podcast. You have just great wisdom, even more than when you were running the joint. And I've got to tell you, this book is terrific. And I want to focus on some of the people may not have heard of, because you have some great leaders throughout this. And I want to start by saying, what do you do when you inherit a company where the culture's broken? What do you do when you're Charlie Scharf?
Well, Charlie Scharf, he's CEO of Wells Fargo. He went in there and he had to deal with a lot of tough stuff. I think they had 13 consent orders. They're knocking all those down. But he had to build accountability into the organization. He had to let everybody know that he believes in them. But he had to tackle the hard stuff. The great thing about Charlie is that he had a sense of urgency to go after the things that had to be dealt with immediately so that this stock could really take off and the company could take off. And as you know, it's starting to move.
Oh, boy, is it ever. And his confidence is back. He didn't want to stick his head up until what he had to do, he had to do. Yeah. But it's amazing. You're absolutely right. He went after the hard parts. He didn't go after the people underneath. He went with the hard parts.
And the other thing he did is he really brought in a lot of top-notch talent that follows him because he's a winner wherever he's been.
He's getting people from the best of firms. Another guy who came in really quiet, self-effacing. I tried to get him to take a bow. He would never do it. But what Frank Blake did at Home Depot, coming in at a very uncertain time.
It's interesting. I just talked to Frank Blake. He gave me a call, and he read this book, and he was very excited about it. But, Frank Blake is the smartest CEO I've ever met.
Really?
Absolutely.
You've met everybody.
Smart. This guy is rocket smart, but he's humble. And he really has that unique combination of what I think makes a great leader. It's the humility you have to say that you don't know everything. You need other people. But you also have to be confident in your capability, which he is. It's just understated.
But he was a lawyer. He wasn't a guy who was with a hammer or did any stuff with plumbing.
But Jim, what he was more than anything was an avid learner, and I like to say action learner, because you can be an avid learner, and you can be book smart, but you got to put it to use, and you got to pair that learning with real insight. And there's nobody better at it than Frank Blake. I know one of the things he did with me is he best practiced our company on recognition, and he went back and made that a big driver at Home Depot. Just an outstanding person.
I met him because I complained on air that my tomatoes that I had bought from Home Depot weren't coming up. And he sent me a bag, and it was a bag of tomato seeds. And he said, why are you doing it from flat? Go do it from seed. Don't bother me. I love them ever since. Came on, the greatest guy. Now, there's a fellow, Neil Bushry, from Workday. And I always try to figure out how he developed such a terrific culture, because it is an amazing one, and they're believers. You say, will you tell what you said in your book about him?
It's hard to believe this, but he interviewed, along with his co-founder, the first 500 people he hired at Bushra, at Workday. And let me tell you something. He then said, okay, I've hired you. You're going to make this company what it is, and I'm going to turn the keys over to you to keep our culture going. But he made it a priority because he knows that having people capability is the biggest driver. And all the best leaders do, Jim. Right now, that's the key.
I want to ask you just for some help on a couple of things. How would you say, is GLP-1 a crisis for the people who run places like Yum or McDonald's, these weight loss drugs? Is it a crisis?
I don't see that. There's always been something that people have said is going to take the industry down. But if you have affordable, convenient food that's good, you're going to win. And I think you'll be winning in the year 2050, the year, whatever.
I like that. All right, so how about some Crystal Ranch and some Pepsi and Cool Ranch? Okay. Tell me what's good, what's bad. Tell me what works and what doesn't.
Well, when you think about Cool Ranch, this is when I worked with Frito-Lay, I call it pattern thinking. What we did is we went to the grocery aisles at that point in time. We found out that the ranch flavored dressing was a hot flavor.
Yep.
Then we said, okay, can we make a Cool Ranch Dorito? And guess what? It happened, and it was a big slap.
Observation, curiosity, execution.
Pattern thinking.
Right?
Just
pattern
thinking.
I like that. And then Pepsi will.
Well, now there's a case where I did Crystal Pepsi when I was running marketing at Pepsi-Cola Company, and that was a great idea. It was a clear cola.
Right.
But what I didn't do is I didn't listen well enough. I didn't listen to our franchise bottlers who said, hey, if you're going to call it Crystal Pepsi, you better make it taste a lot more like Pepsi. And didn't do it, and so a big idea didn't have the success it could have.
You are humble. The stories in here are stories of great humility, but credit. When someone does something good, you say credit them, and it doesn't cost you anything.
Absolutely. I think recognition is the secret weapon of every leader. And I say recognize on purpose. You know, people ask me all the time, how do you drive culture? Well, what are the 4 or 5 behaviors that you know if your team executes them, you know you're going to have success? Then recognize the heck out of those people every time you see it. And guess what happens, Jim? They do more of it.
Absolutely. And that's why you're so successful. And others who read How Leaders Learn will be equally as successful. That is David Novak, Yum Brands co-founder and author of the book, How Leaders Learn. It's out tomorrow. I learned a lot. You'll learn a lot. Mad Money's back after the break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time. It's time for the lightning round. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Cramer's mind. We'll start with Dan in New Jersey. Dan.
Oh, hey, Jim. Thanks for taking this call.
Oh, my pleasure.
Real quick, I was wondering what your thought was on Amazon. For the last 3 months...
Amazon, to me, has a lot of room to go higher. I think advertising is going to be great for them. I think the price of a package is going to go down. But most importantly, what I like about these guys is they've got religion when it comes to dominating AWS. They're back with a great growth number again. Let's go to Chris in Florida. Chris.
Booyah, Jim.
Booyah.
First off, if you ever need a co-host, I'm your guy.
Well, I didn't know that. I wasn't looking, but it's good to write the guy's name. Right. It's Chris in Florida. Okay, we got it down.
I need your opinion here.
Okay.
I've been in the logistics industry for almost 2 decades.
Okay.
And I've never seen a stock beaten down like this one. FWRD, Forward Air. What are you thinking? Back to 100?
No, here's what happens. I got a person on the line who knows this business better than I ever will. Am I going to really opine, or am I going to go do homework so I'm not embarrassed? The answer is I am doing homework to figure out why the heck this stock's down 72%, because I'm not going to have someone who knows more about a business than I am to ask me. That's my job. I'll get it. I promise. George in Arizona. George.
Big old Mad Monday booyah to you, Jimmy Chill.
Oh, yeah,
in
man.
Arizona, and I have a question for you.
Okay.
Old school stock. It's been on a heater for about the last 3 years. Trim, buy, or hold tight. Stock symbol IR. Ingersoll Rand.
Let's just hold on. They are a reconstituted company. They're doing a lot of things right. The fact that it's been flat during this period, to me, says it's about to reaccelerate. Do not touch IR. Let's go to Maria in South Carolina. Maria.
Hiya, Jim.
Hi, how are you, Maria?
Good. Good, very good. Thanks. Prior to the recent dividend cut by Cracker Barrel and the fact that it was down more than 50% since last year, I purchased a few hundred shares.
Okay.
Do you think it's a buy, sell, or hold?
I like this Julie Messino. She's got great background. She's come in. She's taken all the everything tough that she has to take on, she's doing. That, to me, shows leadership. It shows courage. I'm with her. I would not sell that stock. Let's go to Trudy in Florida. Trudy.
Hi, Jim.
Hi,
Thanks so much for taking my call.
Of course.
Sure appreciate your wisdom and guidance.
Oh,
I'm wondering what your opinion of Insmed stock, INSM symbol.
Well, I think that, when you see that kind of pricing of the offering that they had, and it went up so much, I just think we missed it. Okay, we missed Insmed. That's all we can say is we missed it. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
I kept thinking there had to be some method to the madness when someone posted a June 2nd screenshot showing 5 million shares of GameStop purchased outright at $21, along with a huge number of call options owned that could control another 12 million shares. That's all we know right now about this outsized purchase by someone who may or may not be Keith Gill, also known as Roaring Kitty, chief instigator of the 2021 GameStop short busting saga. If you watch Dumb Money, he's Paul Dano's character. But again, everything about the person behind this trade, every news report is pure speculation. Still, why would you ever show your hand like that? Who would disclose that they have such so-called massive stake, as one of the news outlets described it, even though it's really not all that big considering that GameStop's $10 billion plus market capitalization? It doesn't make any sense unless, of course, you're planning to sell into your own hype. Given that GameStop opened up about 75% this morning, it would be such a decent trade, right? Sell, 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 sell. But is it a legal one? The Wall Street Journal reported earlier today that E-Trade is considering removing Keith Gill or the person behind the screenshot from the platform. In the same report, the Journal said, and I quote, the Securities and Exchange Commission has also been reviewing trading in GameStop call options around the time of Gill's social media posts, according to people familiar with the agency's efforts, end quote. And then I had an epiphany. Maybe this is no different from what Ryan Cohen did with Bed Bath & Beyond. Cohen, who's now the CEO of GameStop and most revered by the memesters, very publicly bought $121.2 million worth of Bed Bath, along with a bunch of call options, then dumped everything 5 months later for a $68 million profit. He dumped it even as he agitated and received approval to replace 3 board members that he'd been highly critical of. Cohen really made it seem like he was there to stay, but he later sold his whole stake for $189 million span of 2 days, filed a Form 144 on August 15, 2022, and then dumped his entire stake right after. By next April, Bed Bath bankrupt. Can you imagine? He had 3 people on the board, and he just gets out of Dodge, selling into all the hype his involvement generated among his meme stock acolytes. The SEC's never formally charged him with anything, so I can see why someone might want to follow in his footsteps, even if there might be an SEC inquiry ahead of this stuff. It's like, c'est la vie. But if you're a smaller player, like whoever revealed the GameStop position, possibly Keith Gill, possibly someone else, the lesson is simple. Get like Ryan Cohen, take a big position in an undervalued retailer, getting loud without getting loud. Okay? Getting long without getting loud. No pump whatsoever. Just disclosing your position with some silent memes as well. Then they dump everything into the hoopla caused by the screenshot, because the SEC probably won't care as long as you don't have a man on the board or own more than 5% of the shares outstanding, which is the reporting threshold, and you don't tout the stock. Given that some people come on air and cash their positions after praising them, I doubt the SEC will make a move against who's ever toyed with GameStop as long as they stay below the threshold. Now, if this is Roaring Kitty, I don't know if he can change anything that CEO Ryan Cohen already hasn't come up with, frankly, to say nothing of the couple CEOs who preceded him. I know that if I were Ryan, I would invite him on the board. I just wish they'd find another stock to play around with. GameStop is tired and without great prospects. If it's going to have a chance to reinvent itself, it should be issuing new stock right now to all of the people who are buying it in response to that portfolio snapshot. Right now, GameStop's once again feeling like a plaything, a stock that's just something to fool around with. Again, not to invest in. And again, the SEC has pretty much said by its inaction that it's not going to go after anyone who owns less than 5% of the company for this kind of thing. That's unfortunate, because if you bought GameStop at $40 this morning, you're already feeling like a moron. And I bet everybody who bought it today ends up feeling the same way. Maybe the SEC should just say, you know what? Caveat emptor. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.